I'm Kayla Booker, and in this video, I'm going to walk you through the accounting process, also called the accounting cycle. We will go through each step together, which includes basic transaction analysis, adjusting entries, and closing. Here is our accounting cycle. We are going to go through each of these steps together. We will refer back to this graphic at each step along the way. I like to think of it as the "You are here" stamp on the map at the mall. Our first step in the accounting cycle is to analyze the transaction. Each transaction we record in the process has a dual effect to the accounting equation. Remember, this is the equation that must always remain in balance. So before we jump into the debit this and credit this, I like to make sure that my students understand the effect on the accounting equation. If we do this first, I think it makes the debit and credit stuff much easier. Let's start at the beginning with typically the first transaction to start a company. I am numbering our transactions so we can refer back to them later when we work on the next step. Number 1 says issue $50,000 of stock for cash. What is the impact on the basic accounting equation? We receive $50,000 cash, so the assets, specifically the asset cash, will increase by $50,000. The company stockholders' equity, specifically the account common stock, will also increase $50,000. After this transaction, the accounting equation is in balance. Now, we need a place to do business, so we buy a building. On January 1st, we purchase a building for $100,000. We borrow the entire amount from the bank, signing a 6% 10-year loan. Interest is going to be due on the 15th of the following month. This means our first interest payment will be due on February the 15th. Okay, right now on January 1st, we don't need to worry about the interest. Let's focus on the transaction of purchasing the building. We got a new asset, a building, so we show an increase to the assets of $100,000. This transaction also increases our liabilities as we now owe $100,000 to the bank. We will record this amount in notes payable. So far, both of our transactions have shown increases to both sides of the equation. That is not necessarily the case for all transactions. So let's move on to the more examples. In number 3, on January 1st, we purchased $10,000 of equipment with cash. This transaction will only affect or impact the left side, the asset side, of the basic accounting equation. We increase the asset equipment and decrease the asset cash. Notice how the net effect is 0 on the left side and 0 on the right side. So the accounting equation is still in balance. This is one that my students often find the most confusing. Just remember to ask yourself, what is increasing? Or what is the business getting? What is the impact? Is this going up or down? Ask yourself these questions, then fill in your answers. Once you think you have it, make sure you still have a balanced equation. In number 4, we purchase office supplies. Think of paper, ink toner, file folders, those sorts of things. We have a local supplier who lets us put these purchases on account. This means we do not have to pay for the supplies at the time we purchase them. So there is no cash in this transaction. We get supplies, which are assets right now, ready to be used in the business. We also now owe for these supplies, which increases our liabilities. We show a $1,000 increase to assets, specifically to the account supplies. The amount we owe our suppliers is called accounts payable, and we use that account to show the increase to liabilities. Number 5, on January 6th, we paid $200 for rent for the month of January for office equipment. What do we pay with? Cash, of course. But notice the transaction doesn't say cash this time. This is where accounting students must practice to become familiar with the seemingly endless ways to describe a transaction. Since we paid cash, the asset cash will decrease $200. The rent that we paid was for this month of January, and we say that this is an expense of doing business in the month of January. Expenses decrease retained earnings, which means expenses decrease stockholders' equity. In this balanced equation, both sides of the accounting equation are decreased. One thing you have to have is insurance, correct? Oftentimes, insurance policies are for longer periods. So let's say that on January 10th, we paid $12,000 for our liability insurance. This insurance is for the entire year, January 1st through December 31st. At the time we pay, we now have an asset, a future benefit for the upcoming year. Now, don't worry. Remember, we are only in step 1 of the process or cycle. So before we are finished, you will see how this works out when we do adjustments later on. But right now, this is an asset called prepaid insurance. We paid cash, so we show a $12,000 decrease to the asset cash. Does our accounting equation remain in balance after this transaction? Yes, the net effect to both sides is 0. Remember when we bought those office supplies from a local vendor and put the amount on account? Now in transaction number 7, here on January 12th, we're going to pay that supplier. We pay with cash, so the asset cash decreases by $1,000. We are paying off our liability, so we show the liabilities also decreasing with the subtraction of $1,000 from accounts payable. Are you starting to get the hang of this yet? I hope so. We have just a few more examples to look at together. Has anyone realized that we don't have any customers yet? All we've done is spend money to get the business up and going. Since we need customers, the best way to get the word out about our new business is a radio ad. We called the local radio station to run a commercial this week. The cost is $300, and we asked the radio station to send us a bill. So did we pay for the advertising yet? No. This means we now owe for it. When we owe something, you should be thinking, liabilities. We show the liability accounts payable increasing by $300. This advertising is a cost of doing business. Even though we haven't paid for it yet, we still need to record the expense. This is another tricky transaction that sometimes confuses students. So make sure you look at your equation and make sure that you are balanced. We show the expense as a decrease to stockholders' equity. Well, that advertising must have worked because now we have our first customers. Were you getting worried that all we did was spend money? Okay, we provide services to customers on January 13th, and they pay us $2,000 cash. The asset cash increases $2,000. When we provide services to customers, we earn the related revenue. The revenue recognition principle under accrual accounting is the rule that we are following here. When do we get to record the revenue? When we provide the service. Revenues increase retained earnings, which is a component of stockholders' equity. So for the equation, we show the revenues as an increase to stockholders' equity. Great. Now we have more customers again on January 15th. But this transaction number 10 is different than number 9. Here, we provide the services on account. That means that the customers did not pay us. The account that we use to keep track of amounts customers owe us is called accounts receivable, which is an asset. We show the increase to accounts receivable here under assets. The revenue part is the same as transaction number 9. It doesn't matter when the customer pays us. We record the service revenue when we do the work. We pay our employees every 2 weeks. On January 18th, we pay them for the hours that they worked from January 1st to the 15th. We pay with cash, so the asset cash decreases by $750. Employees are just another example of a cost of doing business. We will record the $750 as salaries expense, since this is an expense of doing business this month in January. We show the $750 decrease to stockholders' equity for salaries expense. Now that you're getting the hang of this, I wanted to give you one of the toughest transactions yet. On January 20th, customers give us $3,000. Okay, if we stop there, we know that that means the asset cash is going to go up by $3,000. So that part was easy. It is the other part of the transaction that is tricky. This $3,000 is for 3 weeks of service to be provided the last week of January and the first 2 weeks of February. My question to you is, have we done any work yet? No, we haven't. When a customer pays us in advance like this, at the time we receive that cash, we now owe the customer the service. And when we owe something in our accounting equation, that means liabilities. We have a special liability account called unearned revenue to keep track of these amounts we owe customers for advance payments. We show liabilities increasing $3,000 in the account unearned revenue. This is another transaction we will see later in the process when we prepare adjustments. I have just one more to look at, though, before next step in the process. Back in transaction number 10, we provided services to customers on account for $5,000. Now, here in transaction 13, we receive $4,000 from those customers. We receive cash, so the asset cash goes up $4,000. When a customer pays us an amount owed, it will decrease accounts receivable. This means that one asset went up and one asset went down. But remember, this is still balanced. I know that some of you are thinking, but what about the other $1,000? They owed us $5,000, but they only paid $4,000. And you are correct. The $1,000 you are thinking about is the balance of what they owed us. And you will see that in just a bit when we cover posting. Here is our accounting cycle again. We just covered the very first step, how to analyze the transactions. We covered 13 examples, which are a good sampling of the type of common transactions you can see. But remember, there are so many more transactions, and that is why practicing with your class materials will be very important. We are ready now for the next step, journalizing. Journalizing is where we record the transactions in the accounting journal. The journal is the chronological record of all the transactions that have occurred for the business. I hope you did a good job in understanding the analysis we just did on those 13 transactions, because journalizing is where we take that analysis and convert it to debits and credits. Now, let's review the rules for debits and credits. Each account used by the business can be shown in this T account format. The words debit and credit simply mean left and right. The left side of the account is the debit side. The right side of the account is the credit side. What you need to understand as an introductory accounting student is that debit can mean up or down. It just depends on which account you are talking about. Likewise, credit can mean up or down. It depends on which account you're talking about. This is so confusing until you get it. So I hope in these next few slides, you get it. What you need to learn is the normal balance side of each of the accounts. Assets, expenses, and dividends have normal debit balances. On the right side, revenues, retained earnings, common stock, and liabilities have normal credit balances. My little memory trick is to say, after eating dinner, read comics loudly. I recommend a flashcard or note piece of paper to write down this and the next few slides if you're struggling with the debit and credit rules. Once you know the normal balance on each side of the account, then you can follow the rules. To make an account increase, you record the transaction on the normal balance side. To make an account decrease or go down, you show the transaction on the opposite side or the not normal side. For example, let's go over the rules for assets. The normal balance side for assets is the left or debit side. To make an asset increase, for example, when you receive cash, you will debit the asset. Each time you receive cash, it is a debit to cash. To make an asset decrease or go down, for example, when you pay cash, you credit the asset. Now, we switch sides when we talk about any accounts with a normal credit balance, such as liabilities. The normal balance side for liabilities is the credit side. To show an increase to a liability account, you credit the liability account. To show a decrease to the liability account, you debit the account. Okay, let's apply these rules to our transactions so we can journalize. I started with transaction number 1 again, which is complete with our transaction analysis from before. Now, we just convert those to the journal format with debits and credits. As long as your equation balanced each time you did transaction analysis, you are guaranteed to have a balanced journal entry as well. This is so cool. Well, I know not everyone shares my awesome excitement of this balancing act, but it's a pretty amazing feature how it will always work when you have done your work correctly. Here is the journal entry format. We always show the debits first and then the credits. The credits are indented over in the area where you write the account name. The rule of accounting is that debits must always equal credits. That means the dollar amount of the debits must always equal the dollar amount of the credits. You could have one debit for $400 and 2 credits for $200 each, and that would be balanced. Remember how I suggested that you write down the debit and credit rule? This is where you can have the rule in front of you to apply the rule. So here, we show an increase to cash as a debit to cash. The increase to common stock is a credit to common stock. Now, we are just going to quickly go through the rest of the transactions. I have included them here in the video, so if you want, you can use the pause button to stop at any time and review the application of the debit and credit rules more closely to each slide. The increase to building, since it is an asset, is a debit. The increase to notes payable, since it is a liability, is a credit. Remember that this transaction had one asset increasing and one asset decreasing. The asset that is increasing, equipment, is increased with a debit. The asset that is decreasing, cash, is decreased by recording a credit in the journal entry. Here, we purchase supplies on accounts. Since the asset supplies is going up, we record the journal entry as a debit to supplies. The liability accounts payable has increased as well as a result of this transaction, which is recorded as a credit to accounts payable. I hope this is starting to make sense and help you with your journal entry preparation. To record expenses, you always debit expenses. This is one where the increase or decrease effect can be confusing. Anytime you pay with cash, you credit cash. Cash is usually the first account to think of when you are working on a journal entry. If you can determine if cash is the debit or the credit, then you are already halfway done. Again, in some transactions, it is helpful to start by thinking about what is happening to cash. Whenever you pay cash, the asset is going to decrease. How do you make an asset decrease? You record the transaction on the opposite of the normal side, the credit side. To record the new asset prepaid insurance, we debit the account. This is a transaction that always seems to confuse my students. The decreasing effect of a liability. Whenever you pay off a liability, the account balance needs to decrease. Since the normal balance side of a liability is the credit side, to decrease the liability, you're going to have to debit the liability. And the decrease to cash is reported as a credit to cash. In this case, to record the expense, remember, we always debit the expense. Since this is on account and it increases our liability accounts payable, there is a credit to accounts payable. The increase to cash is shown as a debit in this journal entry. To record a revenue, you credit the revenue. Accounts receivable is used for the first time in this transaction. Since accounts receivable is an asset, it follows all the same debit and credit rules as other assets, like cash. When the asset's balance is increasing, such as in this transaction, you debit accounts receivable. To record the revenue, you credit service revenue. Here is another payment of an expense. You debit salaries expense and you credit cash. Okay, now this is one of the most difficult transactions. But since we did the hard work in analyzing the transaction already, now we just have to convert that into the debit and credit effects. Cash is received and increasing, so the debit is to cash. Since unearned revenue is a liability and is increased with this transaction, we record a credit to the unearned revenue account. Okay, we are finally to the last transaction. This is another one that is sometimes easy to flip around since it is a transaction for two assets where one is increasing and the other is decreasing. The increase is to cash, so we debit cash. When the customers pay, it decreases the amount that they owe us. That is a decrease to accounts receivable. To record that decrease, we need to record the transaction on the opposite or not normal side of the account. The normal balance side of accounts receivable is the debit side. So the decrease is shown here as a credit to accounts receivable. Let's refer back to the accounting cycle and all the steps. Now, you might be worried right now as we are only done with the second step and are ready to move on to post. But don't worry, the rest of these steps will go a little faster as we review what takes place. I wanted to spend a lot of time on the hard part, which is the transaction analysis and the journal entries for many introductory students. Okay, now on to posting. Posting is the process of transferring the transactions from the journal entries to the general ledger. So if you already have the hard part done, the journaling, posting is going to be smooth sailing. Our general ledger is going to be represented by a T account for each account. This is where we summarize the transactions for the particular account. For example, just by looking at all the journal entries in the journal on our previous slides, can you easily tell me how much cash we have at the end of the month? Or how much customers owe us at the end of the month? No, we cannot quickly identify those answers just by looking at our journal entries. And we only had 13 entries. Imagine a complex business with hundreds or thousands of entries a month. I thought I could show you posting in this video by showing you accounts receivable. In posting, you would take each transaction in the journal and post it to the T account. For our company, we had 2 journal entries that impacted accounts receivable. After posting each of these transactions, you would see both of them in the T account, like I have here. After all the transactions are posted, then you will find the balance of the account. You would add up all the debits, which is easy here, 5,000. Then you would add up all the credits, which is easy in this example, 4,000. Then you find the difference between the total debits and the total credits. 5,000 less 4,000 is $1,000. The balance of the account is $1,000. And since the debit side is larger than the credit side, the $1,000 balance is on the debit side. After posting the transactions and finding the ending balance of each account, the next step in the accounting cycle is to prepare a trial balance. The trial balance is a list of all the accounts and their balances. This step will verify that after posting, the total amount of debits equals the total amount of credits. Now, we have a list of all the accounts and their balances, the trial balance. The next part of the process is the adjustments or adjusting journal entries. Adjusting journal entries are necessary to update the accounts and balances to reflect activity that has not yet been recorded. In some cases, we recorded the initial entry, but now need to update the figures so that our results correctly represent the financial position and activity of the company under GAAP, generally accepted accounting principles. The matching principle and revenue recognition principle should be your guides for this process. Let's go over some common adjustments together. Here is our supplies account. Remember, during the month, we purchased $1,000 of supplies, and there is the debit balance in the account. At the end of the month, we look, and there are only $200 of supplies left on hand. So where did all the supplies go? Of course, we used them. So would it be accurate to report a $1,000 balance of supplies on our balance sheet? No. This is why we need to adjust the books. Now, I like using the T account to figure this one out. The ending balance of supplies needs to be $200. If the current balance is $1,000, what is the entry needed to update the account? We need to credit the supplies account for $800. Now, what do you think the other side of the entry, the debit, needs to be? This $800 represents the supplies used this month. So we will debit supplies expense. Here's the journal entry in the proper format. We would record the adjusting journal entry, often labeled AJE, in the journal, and then post to both of the T accounts in the general ledger. Another adjustment we need to make is for prepaid insurance. Remember, we paid for a $12,000 policy this month. If the $12,000 policy covered 12 months, that means the insurance cost per month is $1,000. At the end of January, we have now used up 1 month worth of that policy. We will show that asset being used up by crediting the prepaid insurance for $1,000. Now, the balance of the account will be $11,000, or the 11 months of insurance that is still paid up in advance. Here's the presentation of the adjusting journal entry. The using up of the insurance is an expense of the month of January. So we debit insurance expense for the $1,000 adjustment. This same methodology would also be used for the rent that our company pays in advance. Here's the one that my students always say is the hardest: unearned revenue. We received $3,000 from customers for 3 weeks of service to be provided the last week in January and the first 2 weeks of February. Now, we correctly recorded that $3,000 in the liability account of unearned revenue when we received the money. $3,000 for 3 weeks of service would only be $1,000 per week. 1 week of service was performed in January, which would mean that now, by the end of the month, we have earned $1,000 of that total $3,000. By performing the service, we have fulfilled $1,000 of our obligation or commitment to this customer. This $1,000 will decrease the liability unearned revenue. Another way to look at this T account is to say, at the end of January, we still owe the customer 2 weeks of service. That is the remaining balance of unearned revenue, $2,000. Here's the presentation of the adjusting journal entry. The debit is to unearned revenue to show the decrease in our liability. The $1,000 of services we performed is now earned, and it can be recorded to the service revenue account. I hope this example really helped, as this is usually the most missed question on my class exam. Let's go through one more example of an adjustment together. This one is for salaries. Remember back in our previous transactions that on January 18th, we pay employees for the work performed from January 1st through January 15th. What about the work they do the rest of the month? January 16th through January 31st. We haven't recorded that yet. Why not? The hours worked by the employees on January 16th through the 31st are paid on February 2nd. Now, this makes sense as I think most of us are used to our own payroll, where you are paid on set days or set intervals. Even though we pay the employees in February, this is an expense for January that we have not yet recorded. Here's the presentation of the adjusting journal entry on January 31st. We debit salaries expense for $1,350 to record the expense this month. Since as of January 31st, we had not yet paid the employees, we show a liability, salaries payable, for the amount that we owe. Now, I know what some of you are thinking, but then what will we record on February the 2nd? I thought I'd show you this here too, just to answer some of those questions that you're thinking, for those of you who are thinking ahead. On February 2nd, we would pay the employees. That would decrease the liability, salaries payable, shown here as a debit to the liability account. This is when we show the decrease to cash with the credit of $1,350. We just covered a handful of common adjustments necessary. There are many more that you will need to learn about when you dive into topics throughout financial accounting. After preparing the adjusting journal entries and posting, you then prepare an adjusted trial balance. Now, this is just like the first trial balance, a list of all the accounts in their balances. But this one will show all the new adjusted figures added. This is your source document of all the accounts and all of their balances for the financial statements. The next step is to prepare the financial statements. For a step-by-step guide in the preparation, check out the lecture on the financial statements that is also part of this series. A lot of students think that preparing the financial statements is the last step in the process, but there is just one more step: closing. Closing is the process of closing out one period to get ready for the next period. In closing, we will close all the temporary accounts. The temporary accounts are revenues, expenses, and dividends. I tell my students to remember the red accounts are closed, R-E-D. Permanent accounts, which are the balance sheet accounts, are not closed. So what does it mean to close an account? Closing an account means making the balance zero. You are cleaning it out, so to speak, to get ready to start over for the next period. We close the red accounts, revenues, expenses, and dividends, to the retained earnings account. Let's walk through the closing of a revenue account together. Here, I have service revenue. And let's say its balance at the end of the period is $10,000. That would be a $10,000 credit balance. To close the account, we need the ending balance to be zero. How do you make the ending balance zero? You debit the service revenue account for $10,000. Here is the closing journal entry, where we debit service revenue to close the account. We close the account to retained earnings. For those of you who understand the calculation for retained earnings, this closing process is so cool as it makes perfect sense. Revenues increase retained earnings. which is why closing the revenues to retained earnings is a credit to retained earnings. Now, here's an example of an expense account. Let's pretend we have rent expense with a balance of $2,000 at the end of the period. So how do you make the ending balance zero? For the expense, we have to credit the expense to make the ending balance zero. Here is the closing journal entry where we see the credit to rent expense. Remember, we close to retained earnings. In this case of closing an expense, we debit retained earnings. Again, this is pretty cool as the process matches the theory. Expenses reduce retained earnings. Now, dividends are going to work similarly to the expenses. So here, I made up an example that dividends has an ending balance of $500. We will credit the dividends account to make the ending balance zero. Here is the closing journal entry where we see the credit to dividends. Now, dividends reduce retained earnings, which is exactly what is happening here in the entry, as well as debiting the retained earnings as part of the closing entry. Once you prepare the closing entries, you post to the general ledger. This is the very last step in the process. Is then another trial balance. This one is called the post-closing trial balance. When you are finished, this trial balance should show a zero balance in all of the temporary accounts. It is a quick check to make sure that you didn't forget to close an account and that debits still equal credits. I hope you found this video helpful in understanding the accounting cycle. It is truly the foundation of accounting. If you liked this step-by-step instructional video, please check out more topics in the Basic Accounting video series with Gleim.